to this computer. All right. For those who don't know me, my name is Sheen Trades. I'm a co-founder of TraderLink. And today's class will be sort of a review of what Vanna is and the impact of IV in terms of price action and how Vanna can take an impact on how the price of the stock moves with magnets and repellents. And then following that, we are going to get into DDOI because everyone seems to be very interested after, there was a big mark of sold puts at 4,700 yesterday that pumped it. Yeah, I almost said co-founder of Apex. That was those are the old times. But continuing forward now, let's talk about Vanna. So with Vanna, the important aspects of it are it is the sensitivity of delta to changes in implied volatility. So how does that play a role? If volatility increases or if volatility increases or volatility decreases, then it can set up different Vanna exposure for certain situations such as magnets or repellents, right? I think this is a really important aspect of understanding how it affects price action. So getting into it, I've obviously made a chart from back then. But starting off, the most basic thing, just a quick review session. The most basic thing of the Vanna curve is that Vanna has the highest effects if the delta is at 0.2. That's essentially where the peak is. And that's where you'll get some sort of magnet or repellent effect. To determine whether or not something is a magnet or repellent, there are many different things. There are certain criteria that is needed, right? So let me pull this up. So let's go over it. So we're going to start off with negative Vanna below spot price, right? And what does that look like? That's basically, let's take this for example, right? That's when you have a bar like this, and then you have a bar like this, and this is where spot price is, right? So that's where spot price is. This is negative Vanna below spot price, right, guys? And that's kind of what you'll see. You'll see a bunch of little bars line up everywhere else too and whatnot. But once again, the most important aspect of it is finding out which one has the 0.2 delta. Usually something like this, you kind of want to check the one with the largest exposure and make sure that it's around a 0.2 delta or near a 0.2 delta in order to get that sort of effect. With that being said, there are different portions to this. So when you have negative on a below spot price, what is the sensitivity to IV, right? So that exposure, so let's say this is a 0.2 delta, for example, right? And let's say IV is increasing. So what happens when you have negative Vanna exposure below spot price and IV increases? This bar with the 0.2 delta will act like a repellent. And what does a repellent do? Is as if price or spot price goes down, and this is repelling price, obviously it's going to repel price back up then. So what happens is the dealers are buying to hedge, suggesting more support, more supportive flows, right? So this is going to be a buy from dealers, right? Does that make sense so far? We're going to stick to the very basics and just give you what the chart represents, right? So the next one is after you have negative on a below spot, what happens when IV decreases, right? What's the next one? It's going to be obviously the vice versa, but we'll draw it out to make it known, right? So now let's say, once again, we remain at a 0.2 delta. What happens as spot price goes down and IV starts increasing? I mean, sorry, IV starts decreasing. If IV is going down, then this will become a magnet. So this will have now a pulling effect and dealers will start selling through, right? So dealers are going to play with the price action. The next important thing to understand about negative IV decreasing and negative Vanna exposure below spot price is that negative Vanna, when it gets passed over, what happens is it creates this accelerant effect, meaning you could potentially dealers will have to initially continuously sell. So if this gets passed over, right? Let's say spot price now gets passed over, right? And we go through that negative Vanna exposure. That means this Vanna exposure, dealers will have to continue to sell even more so, and it'll create some sort of accelerating effect. suggesting that price is going to go lower through that Vanna exposure level, right? This is the same thing with negative exposure above spot price, depending on what IV is as well. So continuing forward, right? So we've covered negative Vanna exposure below spot price. Now the next one is covering negative Vanna exposure, or sorry, positive Vanna exposure above spot price or below spot price. Sorry, fumbling my words. So let me redraw that. So we'll do it like this. You have a positive on exposure bar, and then you have a bunch of smaller bars around it, right? So what is this considered, right? This is the positive on exposure, and this is the spot price. So spot right here. So let's go over the basics again. All right. So let's talk about what happens when IV increases. What does this mean for the Vaughn exposure? So if IV is increasing, and once again, right, we're going down, spot price is approaching the Vanna level. What happens when IV increases is that this becomes a magnetic effect instead of repellent. MAG, there we go, magnetic effect, right? And what happens is dealers will also sell down to it. So dealers are also selling as their hedge. And that's essentially how you can play to its effect and utilize this for price action. So instead of supportive flows, it becomes bearish flows, right? So we're selling down to it even more. Now getting into, and this is when IV, sorry, I'll write this out, IV is increasing. It'll create that magnetizing effect, right? So the next one is what happens when IV decreases, right? It's going to be, once again, the vice versa, but we'll draw it out to make sure people get an image in their head. So if spot price goes down and IV is decreasing, right? If IV is decreasing and it's going down, what happens? It becomes a repellent effect, right? Then dealers will have to buy and show supportive flow. So buy as their hedge, right? And then you can treat this area as support. So continuing forward now, let's get into what happens when things are above spot price, whether you have positive or negative. Does this make sense so far, guys? So I want to make sure I'm taking it slowly, keeping it simple, making it easy to understand. And hopefully these basic drawings can help. So now continuing forward, what happens when we have things above spot price? So spot price is right here, label this spot. So what happens when we have negative exposure below, right? Once again, draw the smaller bars. How you determine it is just by looking at the strike on the options chain, guys. So that's the very basic way. So we're focusing on this one, right? So when you have negative Vanna above spot price, what happens when IV increases? So let's go through the scenario, right? IV starts increasing. And then we're focusing on this bar, right? Because it's the biggest. Continuing forward, when IV increases, this bar will become a magnet, right? So what happens now? If spot price starts approaching it, then what happens is they'll start buying. That means this one will pull it up even more so. And keep in mind, right, the one thing you want to take into account is that 0.2 delta. Because yes, you can have a big exposure bar, but if there's no 0.2 delta on it, then the effect isn't as strong, right? So let's say even the delta here on this in the money call, or sorry, out the money call is we'll call it 0.3, right? Let's say if the 0.3 and price starts falling, right? Let's say price starts going away. Spot price starts going down. Then as you decrease, obviously out the money, what happens is this contract will start decreasing in delta, right? It gets more and more out the money. And when it hits that 0.2 area, then you'll see that supportive flow come in and dealers will start this effect, this magnet effect will start pulling spot price a little bit more up, essentially showing that supportive flow. And that's and how you can kind of time certain bottoms and whatnot, or time certain areas in which the current bottom would be at. So that's kind of how you would go about it, right? So spot price starts falling, but in that delta is at 0.3, that delta is going to fall and get down to 0.2. And what happens is that negative Vanna is going to be most impactful at 0.2, right? meaning it'll start showing supportive flow and pulling it towards back up or pulling it back up towards that Vanna strike. Does that make sense, guys? There's once again, right? There's different ways of viewing this, and this is just a way to take a look at it, right? There's just different ways to utilize the tool, right? And you can use the very most basic version of it where you're not looking at the spot price, you're not looking at the delta, and just understanding how volatility works. And on top of that, treating it as sort of a magnet or a repellent. However, understanding how and when the delta is at 0.2 is going to be the most effective point of Vanna. So in which then you can find the most supportive flows come in, right? Suggesting more buying or more selling and whatnot, right? So moving forward, what happens when IV decreases, right? So let's get rid of these, get rid of all of this. I can't get rid of the dots. Okay. So I didn't have to erase that. I don't know why I did. Spot price, right? And we'll get rid of this. So now let's say, once again, now IV is decreasing, right? I hope you guys are like writing these down or like making similar drawings and whatnot. You can go back and watch the portion of it, but understanding all of this is really essential and really essential to taking the most advantage of Vanna per se. So as IV decreases, right? So IV is decreasing, so this will become a repellent effect, right? Repel price. So let's say spot starts pushing up. What happens? Dealers are going to sell against this, right? They're going to have to sell and bring it back down. And that's kind of like the basics of it. So getting into it again, right? Let's say the delta, let's say this is out of the money and you get closer and closer. And let's say the delta is at 0.15 and it starts slowly creeping up 0.18. And then when it hits 0.2 as you're pushing up, right? Then dealers will start selling against the price action and repelling price from the strike, right? And then understanding, once again, the timing of how the deltas are moving, that can essentially get you the most effect from Vanna, right? And essentially where you'll start seeing, a lot of resistance going up. Yeah, you can utilize, so I talked about this in the previous class. You can utilize VIX. However, that's a 30-day historic average, if I remember correctly. So it's not as effective on a zero-dated basis. But if you want my suggestion, what I typically do is I watch the IV on this, and if it's starting to drop, right, I'll make note of it on a timely basis by 7 o'clock, it's at 160. If it continues to drop at like 7:15, 7:30, and it goes from 160 down to 140, 130, then you'll notice that IV drop, right? So there's a lot of moving parts to this, which is the portion in which it gets a little bit difficult, but once you understand everything and you combine them all together, then you get the most effective use of Vanna, right? And I want to make sure everyone knows those moving parts so that when you do come back and watch this video, you can understand those moving parts and rewatch everything that I'm talking about. Because once again, I want to repeat that there definitely are a lot of moving parts in understanding this. However, once you understand it, man, is it a game changer. People can't trade without this information anymore, especially someone like me. I've been using this information for 2 to 3 years, maybe even a little bit more. But if you were to take this information away, I would feel absolutely naked in the market. I'm talking about the average. So you can just take the lowest point, and just make sure you're watching that and just see the overall total just slowly drop down, right? You can also just view the overall options chain. Just be like in the morning when you look at it, oh, IV's at 70%. But throughout the day, IV starts dropping and it's at 50%, 40%, 30%, right? But and the standard of volatility and how it works intraday is something that I talked about the other class, but I'm gonna once again do a quick review of it, is that when volatility, the overall intraday movement of volatility at open, it's going to be high, right? And by the time, 8 o'clock, 9 o'clock comes, obviously by then there's that IV bleed. Then around 10:30, 10 o'clock-ish to 11, all the way to power hour, IV starts slowly picking up and understanding how that overall, the standard of how IV moves can change the way you trade, especially during weeks like this where Vanna and Charm are having the strongest effects. They're in their window of strength right now, right? And after OPEX, obviously they kind of go away and you focus back on Gamma, but that's essentially the very basics of it. of understanding the timing of how or when to use Vanna. And that's basically, the 2 weeks before OPEX or the week before OPEX or the week of OPEX, right? But yeah. Could you please apply the Vanna example? Yeah, if there is an example, or if there is an example out of it, then yeah, I can look into it. But continuing forward, positive Vanna above spot price now, right? So let's erase all of this. Ignore this. Sorry, I was meant to write everything down, but I started drawing and lost track, but that's not important anymore. Okay. IV is the price of the stock. No, IV is implied volatility of the option. Why can't I get rid of that? Thank you. Okay. So now positive Vanna above spot price, right? So we have positive Vanna above spot price. Right. So we're focusing on this one because it's the largest, right? Spot price is right here. So spot. All right. How to figure out if it, guys, how do you look at an options delta? You view the option itself, right? It's kind of the, how else are you going to view an options delta without looking at the strike? So continuing forward, what happens when IV increases? So IV goes up, right? This will become a repellent. So this one will repel price. So if price comes back up, pushes towards it, what happens? Right? Spot price moves up, then dealers are going to sell against that as their hedge, right? So they sell shares, and this strike starts repelling price away. Perfect, right? That's the very basics of it. Once again, right? You can understand it even more so if. So I'll answer more questions later. Let me just get through this section really quick, and write down your questions on your notepad or on your computer as we go through this, and then we'll get to the questions later on. I just want to get through this so everyone kind of gets the basis of it. But yeah, so if IV is increasing and spot price moves closer and closer, and let's say the delta is at 0.15, right, of this, and as you move closer and closer, and this contract or the strike price goes closer and closer at the money, the delta obviously is going to increase, right? So when it hits that 0.2 delta, then you'll see the biggest effect of dealers having to sell against the move, right? And this strike will start repelling price away. That makes sense so far? So moving on to the next one, what happens when IV decreases, right? Let's erase all this. IV decreases. Erase this, and then erase this. This will become a magnet. So if IV decreases, positive above spot, becomes a magnet. Right? So now looking at this, if spot price moves up, then dealers are going to play with the move and buy as their hedge, supporting the move up to that strike, right? I want to keep it very simple, right? So once again, we're just drawing everything out and visualizing it. But yeah, so that's kind of the basics of everything of how Vanna works, and how, with each, if it's positive or negative above, positive or negative below, how each section react, or each situation reacts with IV changing. And yeah, so getting into the next one, I want to talk about what's called DDOI. DDOI is dealer directional open interest. Okay. So what DDOI talks about and what it shows, right? We look at this chart right here. Don't save. We look at this chart right here. This is the very basics of it. When you see a green bar above the y-axis, the horizontal axis, what does that mean? That means it is bought calls. If you see red above the y-axis, that is bought puts, right? Vice versa. Anything below is considered sold. Right. I want to assume that everyone knows what happens when you sell a option. However, I can't do that, so let's talk about it again, right? I just need a black screen. There we go. Take this. So let's get into it, right? Once again, I know a lot of people may know what selling options do, but we're gonna get into a little bit more detail, right? So obviously puts, right? puts, they carry what's called that negative delta, so 0.5, right? This is bought puts, bought, B-O-U-G-H-T, bought puts. Did I spell that right? Shit. Anyway, now let's get into sold puts, right? They carry positive delta. Why? Because a sold put position is considered bullish. So obviously you buy a regular put, this is bearish. You sell a put, this is bullish, right? Hopefully you guys know that, but getting into it is when you sell a put, what happens? You're credited the amount of premium. So let's say the contract is worth 2.5, right? And you sell a put, what happens is you will get credited into your cash balance $250, right? So what do you want to happen when you sell a put? You want this, the value of the initial contract that you sold, to go down so that you can buy it back for cheaper, right? So now you want this thing to go to 1.0 so that you sold it for $250 and you can buy it back for cheaper at $100 or 1.0, right? And what is your profit? Your profit is 1.5, the difference, right? The very basic. I don't know essentially a better way to explain it, but that's essentially what you want. So yeah, so you sold it for 250 credit. What you want is it to go down. So let's say you select the strike price of $150, right? You sold 150 put. So sold 150 put for $2.50, right? So 2.5. What you want is for the stock, you want the stock to close above 150, right? Because if it closes above 150, then that contract expires for zero out of the money, right? So that's essentially the main focus. You can buy it back whenever you want, the same way you buy and sell options, just vice versa. You sell it, you can buy it back, right? It's the same thing. So getting into, and it's vice versa for calls essentially too. So getting into the other portion, dang it, the part is squishing it down. But anyway, let's delete this now, and then we'll do the same thing for calls, right? So when you get a call, so obviously bought calls, bought call has positive delta, 0.5. Sold call has negative delta, right? Minus 0.5. And this is a bullish position, obviously, when you buy calls for a day trade. And this is a bearish position. Oops. Right? So similar situation. However, okay, I forgot to specify. When you sell a put, what happens is they use collateral. That collateral is money for 100 shares of the stock, right? So let's say, oh, I can't believe I forgot about that for a second. But anyways, continuing with this. Yeah, your assignment risk. That's what they hold as collateral. So let's say, okay, I need to backtrack. I apologize, guys. Completely forgot to mention that the risk behind actually selling options. So bought call or bought put, sorry, and then sold put, right? What happens is let's say you sold a put at we'll use the same example, 150 put, right? You sold it for $2.50. What happens is they're going to take the collateral of 100 shares at whatever strike you sold it at. So 100 shares times 150 is 15000, $15,000, right? So you risk $15,000 to essentially make $2 or $250, right? $250. I hope this isn't boring because you really need to understand this. In general, if you ever sell an option. I thought the OI data was only published twice a day. So OI is published at the morning with the previous closes data. But what the DDOI talks about is it's essentially being able to see open interest live, right? Utilizing the Black-Scholes model. So that's essentially how we create DDOI. Yeah, it's a rolling count of OI. So with the sold put, what happens is let's say it closes below 150. We close at 149, right? What happens is you now are executed 100 shares at $150 per share. 100 shares at $150 per. right? So then now you're holding 100 shares. So when you sell puts on certain stocks, you want to make sure that it's a stock that you really want to actually hold, right? Just because the premium sounds good to sell doesn't mean it may be a stock you want to hold. My suggestion is if you're ever going to sell a stock, you always have to pick the stock that you're willing to hold. Blue chips are fantastic for it. Obviously, premium on those aren't going to be as crazy. However, those are stocks that you can hold perfectly fine and be perfectly comfortable with. Then you can recycle it and sell the the call against it. Again, we'll get into that. But essentially, this is your risk to make a $250 so long as it closes above 150, right? Now we will get into sold calls because that's the next portion of this, right? And such a keen incentive. Yeah. Oh, actually, the whole point of this is to talk about the 4,700 sold strike, but 4,700, right? So if we go back to our Twitter on the account profile, that was the one thing I sent out in the morning because it was weird, right? You typically don't see stuff like this. You had sold puts at 4,700. And as we just talked about, when you sell a put, you don't want it to close below that strike price. And we're sitting here at 46.55, but they sold the 4,700 put. So they sold an option that was super far in the money. It's 45 points in the money, right? So that's the crazy part, which is why it was so interesting to see, is because whoever sold those options at 4,700, they want it and they want it to close above 4,700 so that the contracts basically end up worthless, right? So they sold something 45 points in the money. That in and of itself, take it into consideration. Think about it. For every dollar in terms of that you're in the money in terms of intrinsic value, you get $100. So that contract was sold 45 in the dollar or $45 in the money, meaning there was a minimum of 45.0 in terms of premium, right? Not taking into account other aspects such as implied volatility. So they essentially sold $4,500 contracts in the money. And they made all this premium because guess what? SPX that day closed at what? SPX closed at 47.06. So those contracts went to freaking zero. Yeah, it's a lot of contracts. It was 14,000 contracts. So think about that, right? They made $4,500 a contract. That to me is when I see something like that, that's weird. That is very, very peculiar because who in the right mind is going to sell something that far in the money if they don't expect something to happen? So understanding the sold aspect of it is when you have a sold put is that you don't want it to expire in the money. You want it to expire out of the money so that you make the entirety of the premium. See, that's the interesting part because not many people take that into account. And think about how crazy that is of a move and how much money that person, or not even that person, because OI is just everything on the options chain, right? So, but in terms of it was $63 million in terms of, spreading the wealth, right? And yeah, you can see even here the calls, that is near the highest for calls. You have calls that are in the money that were purchased. Yeah, but this thing purchased calls that far out of the freaking money too. Someone was expecting a huge move. Those contracts probably went from 0.1 to like 700 easily. And if you sold sometime in the middle of the day before it went, those went crazy. So no, it was not long puts. Like I said in the beginning with reading the chart, is when you see something down below the x-axis, it's considered sold. So this was sold puts. You had sold calls right here too. That guy got slammed, obviously. So um, yeah, so that's what I'm talking about as in understanding the sold aspect of this is like, okay, someone doesn't want this shit closing below 4,700. And that is a huge position to be in sold, especially if it's in the money, guys. So that was, and that's the exact reason as to why I posted it is because like it's weird as shit, right? On top of that, we had Apex AI. I know there's at 46.70. This was at 10.18. Look at yesterday's price action. Let's enlarge this one. This was a crazy move, right? At 10.18. So we'll take 1020 for now, right? Apex AI said this 4670. 4670 right here. Boom. Move was caught. Sorry, newbie question. Do we only see data on a daily basis? Yeah, DDOI is for the day. Apex AI was, yeah, it was near open for, it was that the entirety of the day. It didn't change. And obviously we blew right past it, but that's talk about a freaking catch. I know there are definitely some people who got bagged, and we always talk about sizing for zero. But and if you ever, are using something that isn't yours or your setup, and in general, you size for zero, man. Like, come on. Why put a stop loss? Why take let's take, for example, you take $1,000 position with like a 40% stop loss. Why not just put $400 in and let it go to zero? It's the same thing. That's the risk. Then there's different ways of viewing it, but yeah, that's the thing. Our DDOI updates in the beginning and will fill out throughout the day if things change, because it's taking the options data. But yeah, that's it for DDOI. I hope it was helpful in understanding why it was so why seeing that was so weird and why it was so significant. It's not going to work every time. I want to clarify is like, oh, you see something sold so far out. It's not going to work every time. That's not how shit works. There's obviously different success rates and differences. That guy is it's just interesting to see. And when you see unusual data, that's what we pay attention to. If we see same thing with Gex, you see Gex to like a 50 strikeout and it's the AOI, like that's peculiar because you don't typically get 50-point moves. Well, not back then at least. But considering in general, like 50 points in a day is a lot for the S&P 500. Yeah, it is an estimate. It goes through that Black-Scholes model, as I'm telling you. So it's at the end of the day, it's never going to be perfect. We try to make it as close to perfect as we can with our calculations, and that's all I can really tell you guys, without getting into, the coding side of things and the internal stuff. But that's really the gist of it. But yeah, so today we talked about Vanna and the review again over all of them, right? You guys can go back, look at the drawings. I think that'll be very helpful. And then we talked about DDOI, we talked about sold puts and why it was important. Sold calls, similar situation. You don't want it to end in the money, right? You want it to end out of the money. So if you sell a call for like 4,700, you want the stock price to end up below 4,700 so you don't get exercised. But anyway, I will stop this now, the recording at least, and then we'll get into the Q&A.